Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is August 8th, 2012, and my guest is Lee Ohanian, professor of economics at UCLA. Lee, welcome to EconTalk.
Thanks, Russ.
So we're going to talk about the state of the economy, and we're going to draw on a paper you wrote in 2010 in the Journal of Economic Perspectives, and that was the economic crisis from a neoclassical perspective. We'll put a link up to that. And we're also going to, I hope, get to some current work you're doing on the housing market and the relationship between unemployment and the foreclosure issue. And along the way, I suspect we'll end up dipping into your work on the Great Depression as well. I want to start by asking you, what is different about this recession relative to previous post-war recessions in the United States? What's strikingly different?
Okay, yeah, I mean, there's several features of this particular episode that contrast sharply. Changes both in terms of the downturn up to the trough and then also about the recovery. So in terms of the downturn, it's a very severe recession, kind of comparable to the 81-82 recession in which unemployment went up to nearly 11%. What's really different about this recession compared to 81-82 or other severe recessions such as those in the 70s is that there's really no productivity decline. So typically in U.S. business cycles, productivity, measured either as total factor productivity or labor productivity, output per hour.
Output per hour.
Yeah, either output per hour or output per worker. Typically, productivity falls significantly during substantial recessions, such as those in the 70s and the 81-82 recession. In this recession, productivity didn't fall. All of the drop in output was accounted for by a drop in labor input or employment. So that's unprecedented in terms of U.S. recessions. That also is unprecedented when you compare that to the Great Recession in other countries. Canada, UK, France, Germany, Italy, all of those countries had severe recessions as well. Larger, I think, in your data, as you show in the paper, in GDP terms, right? A little bit larger, yeah. A little bit larger. The U.S. was down maybe around 7% relative to a usual 2% growth trend, and those other countries were down between maybe 7 to 9%.
Right.
Those countries, the output drop was accounted for by both a large drop in productivity and relatively small drop in employment. In the U.S., it was all about employment. So the Great Recession in the U.S. is different because it was all about employment. That's very different relative to other U.S. business cycles, and it's very different relative to the Great Recession in other advanced countries.
Before we talk about what makes this one different, let's talk about what makes all those other ones the same. If we looked at post-war recessions in the United States where output per hour or output per worker declined as part of the GDP decline, why would that happen? What's going on typically in those recessions? And then let's talk about maybe why it didn't happen with this one. What's going on there? People didn't forget stuff. So I think people, when they hear, productivity's lower, they think, well, people weren't as productive. Would they forget how to work the machines? What is that?
Right.
What are the data capturing, as best as we can tell, in those so-called typical recessions?
Right. So the 70s recession, the 81-82 recession, recessions of the 50s and 60s where productivity declined a lot in the U.S., that was really the empirical feature that motivated Kydland and Prescott to write, to sort of start the real business cycle literature, which was part of the reason that Kydland and Prescott both received the Nobel Prize in 2004. So what's kind of compelling in an intellectual way about that real business cycle research program is that there's still not a canonical explanation for why productivity declines during recessions. There's a lot of theories on the table, but there's certainly no accepted explanation for that. Some theories are recessions are periods of fundamental changes in business lines and products and the way organizations operate themselves. and this leads to temporary changes in output per worker. Another theory is that monetary policy or financial intermediation doesn't work quite as efficiently as it typically does, and this impedes the ability to allocate resources to the most productive organizations. So those are two theories that are on the table, but we're very, very far from a well-accepted explanation for cyclical changes in productivity.
So we don't have a good explanation, I suppose, then of why this one's not the way it is.
No.
Or different.
No. This recession at some level, so Prescott will argue that the standard measures of productivity, which is, say, GDP divided by the number of workers, is flawed because intangible investment is not well measured in the GDP accounts, and intangible investment, the type of intellectual capital done at high R&D firms. We're sitting here in Stanford, so you've got Yahoo and Google and a bunch of IT companies down the road. Those types of intellectual or intangible investments fall a lot, and that's not well captured. But
so when times are good, we sit around and get smarter, chatting with each other in informal and non-measurable ways. And when there's a recession, when times are bad, people hunker down and don't do as much of that stuff. That's the claim?
Yeah, and there's what Prescott will point to is the idea that you look at the market value of organizations on the stock market, and the value of the physical capital stock, particularly for fast-growing companies that do a lot of R&D, that physical capital can only account for a tiny fraction of the market value. And therefore, he'll conclude the value of intangible capital is accounting for the rest, and we see large declines in the value of intangible capital during downturns. So empirically, that's what he'll point to.
And the U.S. economy today, more knowledge-based, less tangible generally, so therefore it's possible that this would be confounding. This measurement problem is confounding what we're observing.
Yeah, it's the very nature of the word intangible makes it hard to get your arms around. But I think there's some good reasons that might be playing a role. Certainly, it's very hard to quantify the relative effect of that. But
dark matter in economics.
Yeah, exactly.
Yeah. Now, one of the things that's striking, a striking chart in your paper. It just looks at per capita hours worked in the United States over time. And two things are striking about it. The first is the one you focus on, which is the drop during this recession is enormous. It's huge. We've got the paper here in front of us. We're doing this podcast face to face. So between the peak of roughly 2007 when the recession starts, to the drop, and this paper was written in 2010, so you go up through middle of 2008. Just over that very short period, it drops from about 360-something hours. Is this per year?
This is
per capita.
This is per capita.
So it's per population. It's not per worker. It's right.
Right. This is per adult population.
Okay, per adult.
So the working age population.
So 368, say, to 330. 335. It's a 10%, maybe more.
It's close to around a 10% drop. Yeah,
it's huge. But the other thing that struck me about it is that when I'm looking at these data, the series starts in 1956. Between 1956 and 1980, it bounces around. It goes up in good times, goes down during recessions when people are being laid off, obviously, and we don't know whether that hours worked per capita are low because people don't want to work or can't find work. But one thing that's striking about it is between the recovery from the 81 recession, so around 83, to 2000, right before the 2001 recession. So that's about a 17-year period, often called the Great Moderation. During that period, hours work appeared, guessing off the vertical axis, but they go from about 315 to about 380. Which is a 20% increase in per capita hours worked. So that's obviously a combination of increased labor force participation, more hours worked per person who is working, a low unemployment rate. Everything is just humming along, but that growth is huge.
Yeah.
That's a huge part of the expansion in economic activity over that period. So suggesting it's not so much some of it wasn't just productivity, it's just more resources put into the economy.
The 80s were, I
think 90s.
Yeah, the 80s and 90s, probably when economic historians, 50 years from now look back on the 20th century, the 80s and 90s will be called, the golden age of economic performance in the U.S. So we had a severe recession, 81, 82, kind of comparable, roughly comparable to what we experienced in 08 and 09. But then in contrast to today, where we've had literally no recovery in jobs. I mean, today,
mediocre at best.
Employment relative to the working age population is lower now than at the height of the financial crisis in the fall of 08, is higher now than at the NBER-defined trough of the recession in June of 09. In 81, 82.
Say that again.
So employment today.
Employment per rate is lower today. You said higher.
Yeah,
I think you misspoke.
I'm sorry. So employment today relative to the working age population is lower now than it was at the NBER-defined 2009 June trough, and it's lower today than it was compared to the height of the financial crisis when the stock market was falling 20% and everybody thought the world was coming to an end.
So the world focuses on unemployment, which is still quite high, 8.3 in the last data, but in many ways, a more reliable estimate is people working, because there aren't as many measurement problems. There are other issues, of course.
Exactly. And you compare today's labor market with what happened in 81, 82, there's just a remarkable takeoff.
Yeah.
A remarkable takeoff in employment, a remarkable decline in unemployment. There's terrific economic growth that essentially was, with the exception of the 91, 92 recession. Which was mild, continued until a fairly mild recession in 2000, 2001.
Yeah.
And, what concerns me somewhat, one can look at the comparison between the 80s and 90s versus the last decade in a couple of different ways. And the way you look at that really colors your vision for sort of the future performance of the U.S. economy and really living standards. One is that we are in a slump now that we can debate about what should be done to correct that slump and get back on track. Another vision is very, very different, which is before the 08-09 recession, so 02 through 07, which came out of that mild recession we just talked about. We didn't have economic performance during those, quote, expansion years, nearly as good as we had in the 80s and in the 90s.
Right.
So job creation, business startups, and in particular what I'd like to look at is job creation at small, fast-growing firms. We know that GM is not going to be the big jobs creator unless somehow China falls in love with GM products. Maybe they will, and hopefully they will.
Yeah. Or GM discovers some new technology that we don't know about. But it's not the Chevy Volt, as far as we can tell.
It's not the Chevy Volt, but typically those big companies are not the big job creators. The big job creators are those small companies that then take off. Job creation at those small startups is way, way down. So when I look today, not just today, but if you look at 02, 03, 04 through 07, it's not nearly as vibrant an economy during those expansion years as it was during the 80s and the 90s. And when I look at that data from a longer run perspective, I'm much more concerned about the future of the U.S. economy than simply saying, we still haven't quite gotten it right from the most recent recession. And
you're saying that. I assume you're saying that because it suggests there's some structural issues that this recession might be masking, that it's not just the recession, there's other stuff going on that's making things not so good.
Earlier you asked me about what was really different about our current episode, and the recovery now really, really jumps out. So you asked me about this paper I wrote for the JEP a couple of years ago. So it was a really interesting project. So Chad Jones, the editor of the JEP, asked me...
It's the Journal of Economic Perspective.
Journal of Economic Perspective asked me if I'd be willing to write something, and I kind of specialize in economic crises, so I said, sure, this sounds fun. So there's a symposium in Economic Perspectives. Bob Hall, Mike Woodford, Ricardo Caballero, and I think David Leibson were the other authors of papers. And they're all very, very different.
No doubt.
For listeners, all of them are really interesting reads. But when I wrote that, the conclusion I reached was, it's not so much about a financial crisis. It's more about labor market issues, or if you want to think about the financial crisis, it's why does that impact the labor market so much? And I wrote that.
Not obvious.
Yeah, and I wrote that about 2 years ago, and the labor market looks the same today, or perhaps even worse than when I wrote this first 2 years ago, which is really, really disturbing. So it's really unprecedented to have, literally no return to normal employment level. I mean, as I mentioned, employment to population today is lower than it was in June 2009 when the NPR defined the trough. So you say...
That's the start of the recovery.
The start of the recovery, yeah.
Officially.
So you look at that performance, and that's not only abysmal, but it's unprecedented. I know we'll talk about the Great Depression a bit later, but even in the Great Depression recovery, you had at least some job recovery. In this one, you're really not seeing any at all.
So now, there's a bunch of things to talk about, but one is we never really talked about this explosion and the reasons for this explosion in labor market activity post-81, 83, 82 recession. And I assume I'm not very familiar with, that's a polite way of saying I'm unfamiliar. I'm not very familiar. I'm unfamiliar with Prescott and Kydland's work, other than to know that they put a lot of stock in marginal tax rates falling or rising. So they explain large differences between Europe and I know Prescott explains large differences between Europe and the United States working hours, not because the French like siesta, long times in cafes sipping wine, but because they have a different return and incentive from working because they have higher marginal tax rates. Is that the standard story for this long secular rise between, say, 83 and 2000 in hours worked per capita, that it was a period of time in the United States, at least in the first part, when marginal tax rates were falling? What's going on there?
Yeah, no, that's great.
Or do we not know?
Great question. So you mentioned the research that Prescott did about tax rates. So I did some research on that with Richard Rogerson at Princeton and Andrea Raffo, former UCLA PhD student who's now an economist at the Federal Reserve Board. And what we did was we expanded Prescott's idea substantially, both over time and across countries. So we looked at how much can changes or differences in marginal tax rates that affect individuals' time allocation decision. So essentially, you just talked about the incentive to work. So the incentive to work depends upon the return to working relative to the value of one's time in non-market activities. Okay. And there's enormous dispersion in the tax rates that affect that return to work across countries. And we have pretty good data from the OECD. And what we found was striking. So in the 1950s and 60s, total hours worked in a country relative to the working age population, so that's kind of the standard measure that a lot of economists use, was higher in Germany and France and some of the other Western Northern European countries relative to the U.S. It's now on average about 20 or 25% below what the U.S. level of work is. And we found that a big chunk of that could be accounted for differences in marginal tax rates. And in particular, you look at countries like Germany, France, some of the Northern European countries, and you see negative lockstep movements with higher marginal tax rates, large drops in hours worked, and I just want to put a footnote to that. Sure.
Large drops in hours worked in taxable activities. It's
exactly.
Not necessarily true that people are sitting around in the cafes when they're marginal tax rates. A lot of them are doing what we call uncovered work, or work in the black market, or
no, absolutely,
cash.
Absolutely, yeah. There's non-reported transactions, and there's probably more, what economists call home production.
Yeah,
some of those countries.
We call it home production, but a lot of times it's work. It could be you're fixing your own house instead of working and hiring someone to do it, but it also is sometimes you're paying your neighbor to do it and you're giving him something in return that's not taxable.
Right, no, absolutely.
You're painting his house and he's paving your driveway.
Absolutely. So just as a sidebar, I visited the Swedish Central Bank a few times, and I remember having lunch with one of their economists, and he said, do you know why we don't have home painting industry in Sweden? I said, I said, well, there's no.
How do you respond to that? Yeah.
And he said, one of my colleagues estimated how much I would have to earn in order to pay a painter $1 after taxes. So marginal tax rates, the Reader's Digest version is marginal tax rates are so high that one would have to earn something like, I don't know, like 18. A person would have to earn about $18 or $19 if their painter was to receive $1 after taxes. So that's going to be, so the homeowner is going to be taxed once, and then the home painter is going to be taxed at another time. It says we all paint our own houses because it would just be just be way too expensive. So so your point about market recorded activity is absolutely correct. That is absolutely correct.
I mentioned that just because I think our ability to precisely estimate traditional labor supply elasticities, that is, how much people respond to incentives, and I think armchair theorizing, when you think about how much you'd respond, it's not always obvious to me the effect's as large as some claim. But when you include this kind of effect, especially at very high rates, I think you start to get large responses.
Right. What convinced us that there's significant merit in this particular theory were really kind of two pieces that come out in that study, which it was published, I believe, in the Journal of Monetary Economics in 2006. One is that some of the European countries did some reforms. So in the late 80s and early 90s, some countries reduced marginal tax rates, not to levels commensurate with the U.S., but they did reduce them, fairly significantly. And what you then see is you start seeing increases in market hours of work in those countries where you do see the reforms. The second is that we fit a number of regressions of trying to account for how much taxes could account for this factor compared to a host of other labor market indicators that economists often point to as depressing European hours of work, such as the level of unionization, the extent to which it's centralized, employment protection legislation. And what was pretty striking is that the R-square in the simple regression that includes only the tax factor is almost the same if you add in any one or two or the entire kitchen sink of all those other variables. The coefficient doesn't change in terms of magnitude, and the t-statistic doesn't change as well.
So the R-squared is the proportion of the variation explained with just one variable, and the t-statistic is how significant it is.
Yeah, no, sorry about the jargon.
Probability of being significant.
Yeah, I got excited there and lapsed back into...
That's okay.
So in terms of the 80s, I do think that was a very, very important factor. There were large changes in taxes in the U.S. in the 80s, and I do think that was an important factor in what you might call the U.S. economic renaissance from a pretty abysmal decade of the 70s. It was also the case that was sort of the birth time, or roughly when information technology really started to take off. It was the 1980s. And then you also mentioned the 1990s, and then we get the internet boom and venture capital funding. Some of the incredibly successful companies that are sitting around here at Stanford. So I think those two factors played an important role in the 80s and the 90s.
Of course, hours worked per capita rose pretty significantly in the 90s as well as the 80s, and we raised taxes at the beginning of that period, I think, and in the middle. So there have got to be other things going on there. Now, the other thing, I want to come back to the labor market again, but before I do, I just want to hear you talk about one other factor that struck me as dramatic looking at your summary of this particular recession, which is business investment. The decrease in business investment in this recession relative to past recessions is quite large.
Yep.
Is that correct?
Yes.
Any thoughts on that? It hasn't recovered very well, is my impression.
And no, it hasn't. It hasn't recovered that much. And this is a little bit like the 1930s.
Right.
And I know we'll get that to that in a few minutes, but one parallel is investment during the 30s was, even during the recovery, was still 50 or 60% below trend. I mean, just remarkable.
In the 30s?
In the 1930s. Here, we're nowhere close to that, but again, we're nowhere back close to trend. So what's interesting about today's economy in terms of the corporate sector, in terms of what they're doing with investment of plant and equipment and with the decisions they're making towards hiring new workers is that those companies, their cash positions, their liquid asset positions are at least back to where they were before the financial crisis.
Have a lot of profits. Profits are high. Have a lot of cash on hand. A lot of successful companies are sitting on money, not doing anything with it.
They have tons of cash, and not only the non-financial sector, but financial sector profits, which of course which were negative at the height of the financial crisis. Those are back to where they were before. Partially because your tax dollars, my tax dollars went to subsidize.
We made our contribution.
We made our contribution, and
we're waiting. See them back on their feet.
We're waiting for those dividends.
Yeah, they say, don't hold your breath.
Yeah. So
why is that? This is again a big puzzle. Why aren't businesses investing more? They've got the wherewithal. They have cash. They have plenty of money. Some people have suggested, well, they've run out of good things to do with the money. I find that hard to believe. They have in some dimension, right? They're not using it. Is that because they can't think of anything? I tend to be sympathetic that they're anxious about the future. They're waiting on the sidelines to see what's going to happen.
So the statement that they've run out of things to do with their cash. In some sense, that's the tautology from the standpoint that bad times are always times by definition where there's not a lot of good investment opportunities.
That's true.
So then the question is, why are there bad times?
Yeah.
And I think there's probably, in my view, there's sort of two theories.
Hold that thought.
Okay.
I want to come to that in 1 second. Okay. That's what I want to turn to next is those two theories.
Okay.
But before you do, I want to ask you one other thing about the labor market that struck me. We had a conversation yesterday before this interview. Something I've noticed as well, which is in every recession, higher educated people are hit less hard than lower educated people. It's pretty dramatic in this recession, though. Among college educated workers, unemployment, it's higher than it was in the best of times, in 2006, say. But for low skilled people, low educated people with a high school degree or who didn't finish high school, it's devastatingly bad. Which is why, again, we're doing this interview in Stanford, California, Stanford campus. You can walk a quarter of a mile from here to the Stanford Mall, which is on El Camino at the intersection of Palo Alto and Menlo Park, and you'd think you were in the flushest economic times ever. This area, which is high education, has tremendous economic health right now. I live in Washington, D.C. area when I'm not here in the rest of the year. And of course, its main industry is government. It looks flush and normal. And of course, it's a very high education area, the nation's capital. Places that have lower education have struggled terribly and are doing much, much worse than the national average. What do we know about that? What's going on there?
I mean, I think you hit the nail on the head. And part of the solution to long-run visions of the U.S. economy is dealing with the fact that highly educated people, they have, on average, remarkably good-looking futures, and those with low levels of education, I hate to say the word are doomed, but I think a lot of them are. But you hit the nail on the head with that. So, one can obtain, data on unemployment rates by age, by education level, by various types of demographic and socioeconomic factors, and the data just jump out at you. So you mentioned unemployment rates among those with, say, college completion or advanced degree. It's around 5% unemployment,
4 point something,
and maybe up from 2%. But
so it's double, but it's from very small.
It's from a very, very small base. Yeah, it's from a very small base. And when you look at those individuals with the lowest levels of educational completion, so those who haven't finished high school, it's a disaster because their labor force participation rate is about 20 percentage points lower than it is for highly educated people. So their labor force participation rate is somewhere around 68, 67%. So not that many compared to other groups are working or looking for a job, and those who are in the labor force, their employment rate is 15, 18, might be even as high as 20% at some point with the last couple of years. And those who are working have wage rates that are incredibly low. So, I looked at some data about the median wage of, the wage of the median unemployed person. This is the median unemployed person. And in $2005, it's somewhere, their previous wage was somewhere around $13 per hour.
Before they were unemployed.
Before they were unemployed. Now we know from a lot of research, some of it which goes back to 20 years, by guys Jacobson, Lalonde, and Sullivan, which was a 1993 American Economic Review paper, and then very, very recent work by Steve Davis at Chicago and my colleague Till von Wachter, that individuals who suffer job loss during a period of severe recession take enormous wage cuts when they ultimately do find a new job. So you're somebody earning $13 an hour, and the fact that on average you're going to take a big wage cut, a lot of those people are bumping up against minimum wage legislation.
Which is why also that we had a previous interview with David Otter out of MIT on the disability, growth in disability roles. Tremendous growth.
It's huge. Yeah.
Which is some of those folks.
It's huge.
They're disabled in, not in the way we traditionally think of disabled. They're struggling to find work. They find a doctor who will say that they've got something that makes it hard for them.
Absolutely. So when you sort of say, why is it different now compared to sort of in the past? The theory that I think has some merit for this is the fact that highly educated people can make very productive use of new, cheap, sophisticated capital equipment such as information technology. So you give a college graduate, fax machines and cell phones and personal computers with advanced software, it makes them incredibly productive. A lot of those machines and technologies are taking the place of workers with low. Yeah, my favorite story for this is you look at, say, the ports of New York and New Jersey. So in 1950, think about roughly 10,000 guys, longshoremen, big, strong guys with strong backs worked there. They'd pick up a box and put it on a ship, and take a box and take a box off the ship. So that was the technology for offloading international commerce. Today,
no person touches anything.
Today,
except who operates the crane or whatever.
Yeah, the crane. Yeah. So today,
forklift.
I think about maybe under 1,000 people. So there's been a drop of a factor of 10 drop in employment. They're all college grads operating, multi-million-dollar. You drive past any port and you see these remarkable cranes. They're picking up these large containers.
Yeah.
And those union guys, the 6'1", 250-pound guys that could pick up anything, they're not around anymore. That job is that unskilled labor lost that job to capital goods.
And that guy's moving a piano for his neighbor in a moving company, and it doesn't pay what it used to pay.
It doesn't pay nearly what it used to pay. So this process of cheaper, better capital competing with low-skilled labor has been going on for a long time now.
Well, so that, we're off what we're talking about, but that's okay because I think it's very interesting. I think normally in economics we say, well, that's creative destruction. We find a more effective way to unload those ships. That way it's cheaper to unload the ships. That way there are more ships, and the things that come off the ships don't have to be as expensive. Yeah. And resources are freed up elsewhere in the economy, and that's usually a glorious thing for the standard of living and even for the average person. I think the challenge is for some of those low-skilled people, they're not tooled up to take advantage of the new opportunities.
That's exactly right. A lot of those people are not competitive in today's labor market.
And so the part I think about more than what you're saying, though, is sectoral specific. So I look at construction and manufacturing. You're really talking about manufacturing to a large extent. There's a long trend. It's 60, 70 years old and probably longer, where machines have replaced workers. The number of workers necessary to build a car is a fraction of what it is. So GM is, even if GM were thriving, it wouldn't have 750,000 employees, and it just doesn't need the number of people it used to have. That's true across all kinds of manufacturing. But that trend started in probably 1945, and it just keeps going, and we did fine as an economy, and the average person did fine, and the low-skilled worker did fine. New opportunities opened up elsewhere to do other activities that now were done by machines. But in construction, we had this massive boom artificially stimulated, I believe, by government housing policy. And as a result, in certain areas where it was easy to expand, Nevada, so-called sand states, Nevada, Florida, Arizona, parts of California, huge increases in the number of workers. And those jobs have not come back. It may not come back for 5 years more. And those workers, who were laying drywall and building houses, they're not working on the stimulus package highway thing because they don't know how to drive those machines. People think they're going to somehow be stimulated by this. They're not. And that housing, that sector alone is a huge chunk of low-skill unemployment, it seems to me.
Yeah.
So it's not maybe as bleak as you think. It's still bleak, but there's the sickness of the housing market, which we're going to get to also in a little bit, it has made it harder for this recovery to look like other recoveries, and made it harder for those people who were drawn into those sectors and now can't find anything else, or are waiting, coming back. They want to, as a carpenter, they want to make that whatever it was per hour job, and it ain't coming back for a while. But they're sitting there waiting.
I think there's a substantial component of workers that are in that position, such as I was making $25 an hour.
I take a $15 an hour job. I can do better. But they can't. They don't realize. But they're waiting, hoping, taking unemployment. Which is not very generous, by the way.
No, and obviously, it steps down over time. This is different from this particular period in that we did have the construction boom. We have all those houses sitting in Nevada now that maybe they'll get populated at some point. Who knows? But that did provide employment opportunities for a lot of people that were relatively low skilled. And
new housing construction is not bouncing back because of that big overhang of both unfilled houses and houses that are being foreclosed on.
No, exactly. That's exactly right.
So let's get to the cause of this malaise. As you started to say, there are two sort of stylized explanations for why this recovery is so mediocre. One is that, go ahead.
Yeah, so one is that there's a lot of uncertainty about economic policy, and that's holding back businesses from investing and from hiring workers. And that's an interesting theory from the standpoint that from economics, any activity where there's a large fixed cost associated with the decisions, and there's certainly big fixed costs associated with building a new factory or office building, and there are fixed costs associated with hiring a worker. You've got to train them, you've got to bring them on board, you've got to integrate them in the organization. Both of those decisions have big fixed costs. So
fixed meaning if you hire them for 6 weeks, 6 years, there's still a big upfront.
You've still got to pay that upfront cost. Exactly. You've still got to pay that upfront cost. And so recent theoretical work in economics has emphasized how uncertainty about the future leads those decision makers that face those upfront costs to delay their decisions until there's a little bit more clarity. So that theory says, you know what, we've got this dysfunctional Congress, and we don't know if there's going to be taxes are going to go up next year to the extent that they are prescribed to, or if there's going to be a deal in Congress. We don't know who's going to be in the White House. Republicans and Democrats can't seem to make any decisions. Who knows what's going to be looking like in terms of 2000?
We have large sectors of the economy under new regulation where the legislation isn't even completed. That would be healthcare and the financial sector.
Sure, Dodd-Frank is far from done. Right, there's Obamacare. Some parts haven't even been touched. It's a remarkably complex piece of legislation.
So I'm sympathetic to that argument, but I think there's some problems with it. We'll talk about it in a sec. First, let's get to the second claim. What's the second?
The second is more ominous, and we talked about that a bit before, which is the U.S. is not as vibrant of a long-run economy as it was in the 80s and the 90s, and that low investment rates reflect. Low investment rates are oftentimes a very good predictor of future economic activity because investment is done with the anticipation of what it will yield in the future. And again, kind of going back to the analogy with the Great Depression, massive collapse. There's a 90% drop in investment in between 30 and 32 or 33. It didn't come back really much at all in those recovery years. And my sense is that it didn't come back because businesses looked to the future and said, the long run is not looking very good for this economy. I worry that some of that may be playing a role again today, and the data that leads me to think that might be somewhat of the explanation is that the expansion years between the 2001 recession and the Great Recession, those were not particularly good years compared to the 90s or the 80s. So we seem to have a more sclerotic economy.
But that's so the first explanation is bad policies or blundering by policymakers. The second is there's some structural problems we deal with. But there's a third explanation, which I thought was going to be your second, which is we're coming out of what's unique about this crisis and recovery is that it was driven possibly, although this is not even clear either, but some would argue it's been driven by a financial crisis, that the banking sector, the shadow banking sector's collapse is why this has been such a mediocre recovery, and that's generally what happens after these kind of situations. The Great Depression being an example. We had a terrible collapse in the banking sector in the 30s, says the argument. Lots of bank failures, lots of difficulty getting financial help, and that meant that the recovery is not going to be very good. And people made the same argument for this particular recovery. So among those three, bad policy, structural problems, and a financial crisis, where do you fall in? What do you think is the most important?
Yeah, I put stock on sort of bad policy / policy uncertainty as we go forward. Certainly when you look at the American Recovery and Reinvestment Act, which is more popularly known as the stimulus plan, it's hard to make the case that it did very much, unless your vision of the world was going to be 15% unemployment or 18% unemployment. You look at cash for clunkers, it seems like it just stole auto sales from the future. You look at the home buyer's tax credit, it didn't do much to help the housing market. But those were all incredibly expensive policies that helped us rack up a lot of debt. So you think about bad policies, yes, I think that played a major role in why we haven't had too much recovery. I don't subscribe too much to the slow recovery because of the financial crisis view, and that makes me quite different than a lot of economists. But
why not? You have some interesting evidence. It's tough. Obviously, we're in what Jim Manzi calls a high causal density. I mean, there's a lot of things going on at once, and there's a temptation to cherry pick the causes you like and to discount the causes you don't like. But you do provide some evidence for the financial sector not being as important as some people claim. What's your argument there?
Right. Well, so many people now cite we have a delayed recovery because we had a financial crisis, and they'll point to work by Ken Rogoff and Carmen Reinhart.
Right, who we interviewed Carmen on this program.
Okay, terrific. But the U.S. doesning look like those crises, and here's why I say that. So I'm doing work now with a former PhD student of mine, Zhang Ho, who's now at the International Monetary Fund, and Ellen McGrattan at the Minneapolis Fed. And we're looking at a number of recoveries following financial crises. And yes, GDP recovery is delayed, but it's not because of employment. Employment comes back. What doesn't come back is productivity. So we can always just arithmetically decompose changes in output identically into two pieces: output per worker and the change in number of workers. I mean, that's an identity. And in a lot of the Reinhart-Rogoff episodes, at least the ones we're looking at, they're fairly recent ones. They're not ones that go back, into the early 1900s to the 1800s. The delayed recovery is because of productivity. It's not because of employment. We're the exact opposite. Right. We're not having a delayed recovery in productivity. Worker productivity is higher than it's ever been by a substantial margin. We're having delayed recovery because the labor market's not coming back. So that's one reason, my view is that's not really the explanation of what's going on here. And then the other reason is, we talked about before, the corporate sector is largely self-financing. They got tons of cash. They have tons of cash.
So they don't need the finance. It's not like they can't, their local bankers gone, so they can't finance their new plant or their new activities. You're saying they don't need their local banker like they used to.
They don't need their local banker like they used to. they're not up against some borrowing constraint where they're saying, if only I could get a bank loan to undertake this great project over here.
But aren't there people who say that the commercial paper market collapsed, that you couldn't get short-term loans, that banks that firms couldn't get liquidity in the aftermath of the crisis? You know, we're talking about the 08, 09 period that the money market was in shambles. The government had to step in. There's a lot of, seems to be some evidence at least that there were some financial challenges.
There were tremendous dislocations the fall of 08, and and I don't downplay those dislocations on the economy at that time. And my own sense is some government handling of the crisis could have been done better. Now they were operating in real time, and
are you sure?
so that was, it was a difficult situation. But what you see after this crisis is some interest rates shot up like crazy in the fall of 08. They came down pretty quickly in the spring of 09. Now we're almost 3.5 years past the spring of 09.
That's true.
A lot of the markets that kind of dried up. Again, we mentioned earlier about the difficulties in inferring cause and effect. The Fed stepped in substantially and basically, took over activity in some of those markets.
Yes, they did.
So when you look at bank lending today, it's lower today than it was at the height of the financial crisis.
Why?
So again, my sense is that there's just not a lot of demand for loans out there.
Right. I agree with that, because then the question is why. We don't really know. But
so then we go back. We go back to those.
Things are bad. And why are they bad? Because
we go back to those explanations about, is it uncertain policy? Is it?
Well, let's talk about uncertain policy, because I'm sympathetic to that. But as many people wisely point out on the other side, there's always uncertainty. First of all, tax policy. Tax policy is changing all the time. It's not a secret that we're spending more than we take in. It's true, we've spent a lot more than we take in, but I think there's not that much uncertainty. The tax rates are going to have to go up. Some aspects of taxes are going to increase, because you can't run $1 trillion deficit every single year, and either we're going to spend less or tax more, but eventually we're going to have to tax some more because I don't think we're going to be very good at spending less. So how do you, let's talk about the Great Depression as well, because you've made the claim, and we've had Bob Higgs on, whose work I respect, talking about the policy uncertainty, discouraging investment and future looking. So it sounds nice, but hey, it's always uncertain, the policy environment. Why, other than the fact that it coincides with our view of government not being a very effective steer of the economy, how do we know this is really discouraging things?
No, all those are good points. What I would say is unique about this particular episode is that we haven't had a 70% publicly held debt to GDP ratio before, which really highlights the importance of fiscal imbalances. Politicians in the past, whether Republican or Democrat or anything else, were able to successfully kick the can forward on a lot of entitlement issues.
We're getting close to the wall where you can't kick it any further down the road.
So now we're close to the wall, and so now voters are finally saying, "Oh, now I see." And of course, there's nothing new about a lot of these issues.
Right.
Unfunded pension liabilities, particularly in the government sector, this has been around forever. Forever meaning 30 years. So there are some novel features of today's economy, including a Congress that can't seem to work together at all, including a big new healthcare program that we've never really had before, in the sense of what that means for the future and how that's going to impact businesses. Businesses are going to say, okay, am I going to offer it, or am I going to pay the tax? Is it going to, the businesses I talk to still are pretty uncertain about how it's going to impact them. We mentioned Dodd-Frank a couple of minutes ago, which is a behemoth, one that I'm not particularly positively disposed towards. We still, in my opinion, have too big to fail, in my opinion, sort of cemented in by Dodd-Frank.
Well, that's the biggest problem, I think.
So I do think there's some features of today's economy that do raise more uncertainty than in the past. And at some level, it's really hard to distinguish between are businesses holding back on investing in plant and equipment and hiring workers because they're uncertain about what's going to come next year, or whether they just don't think no matter who's in the White House or who's in Congress, we're not going to have nearly as good of an economy as we had, say, in the 80s and 90s. It's really hard to distinguish between those two hypotheses.
That's a great point. I think they tend to get lumped together. It could be that people are uncertain about the future. It could just be they think it's a bad future.
It could
unfortunately.
be. That's what I'm worried about. And really worried from the standpoint of, we talked about labor market a minute ago, really young workers and workers that aren't competitive in today's job market, given their limited education completion.
Yeah, well, certainly a long run challenge. I mean, our education system, it doesn't need a reform. It needs to be
maybe a do-over.
Something else. Yeah, a reform is misleading, as if there's a switch. We just have to flick the right switch. I think
there's some modest changes to be made.
Right. I think we need some radical restructuring, and we've talked on this program about the STEM phenomena. I think it was Alex Tabarrok, the science, technology, engineering, and math, and that's always going to be a smallish portion of college graduates.
Yeah.
And saying, well, we just need more STEM graduates so they can be part of the modern economy is not the right answer. And we also had an interesting conversation with Adam Davidson from Planet Money about some of the revolution going on in manufacturing, where it's actually there's a lot of high-skilled work being done in manufacturing requires calculus and
absolutely, yeah.
It's fascinating, that revolution as well. It's unseen. I don't think most of us are paying that much attention to it, but it would be nice if there were more creativity in the education sector to allow people to find ways to get skills they could be productive with. Let's. I want to ask you a little bit more about the Great Depression.
Sure.
You've written some very interesting things about that. Then we're going to turn to the last part of this on the housing market. It's always, let me say it differently. We don't measure uncertainty. It's not like, it went from 6.3 to 7.7. That explains it. So I'm sympathetic to the argument that healthcare and other transformations here have created more uncertainty, and maybe worse, created a bad perception of a bad future. I think the other side would argue, people who favor that would argue, no, it's improved our healthcare situation, and that's a crucial part of productivity. So I think there are arguments on the other side. But let's move to the Great Depression. The standard Keynesian view is, we just had a loss in aggregate demand, and until the war came and government spent like crazy, we didn't recover. You tell a very, very different story that must cause you to be very unwelcome at a lot of cocktail parties. So I lay out a little bit of that case for why the policy environment of the Great Depression extended it, and it was not the aggregate demand problem that many people argue.
Sure. The Great Depression is fascinating. It's unprecedented in duration. It's unprecedented in depth. People talk about today's dire economic situation. Nothing close. You're talking about unemployment rates of 20%,
25.
Investment that was 90% below trend level.
Yeah.
Just remarkable times. In fact, the reason I study economics is because my dad grew up during the Great Depression, so whenever my grandparents were over at the house, that's all I heard. This was, in the 1960s and 1970s, I heard people, adults still talking about what happened, 30 years,
well, that's why my dad
before.
Doesn't invest in the stock market. Because it's dangerous. He invests in junk bonds, which are dangerous. But to him, it's not the stock market.
My dad must have talked to your dad, because he never invested in the stock market. T-bills were great.
Yeah.
So kind of any theory of the Great Depression has to say, why didn't it happen before, and why didn't it happen afterwards, and why did it take 10 years to get anywhere back close to trend? So something must have been fundamentally different, and I think a lot of data had not been explored very systematically, at least from the standpoint of kind of standard economics. In fact, when I first went to teach at University of Minnesota, kind of Ed Prescott was a colleague of mine there. He would win the Nobel Prize a few years after that. And I would say, Ed, what do we know about the Great Depression? He would say, we know nothing. We need a whole different economic theory to understand the Great Depression. And I'd wanted to do a dissertation on the Great Depression when I was in grad school at Rochester. And my professor at the time, Bob King, you probably know Bob King,
Sure.
Alan Stockman,
Yeah.
said, "Oh no, don't do that. Don't even think about doing that. We think you can do okay,
You're a smart guy,
but don't go there. No PhD student should write about the Great Depression." So I got to Minnesota, and I started thinking about this, and my colleague Hal Cole was the Minneapolis Fed, and we started talking about it. And we said, okay, well, let's see what we can learn about it. And what was really unique is there was sort of an unprecedented level of what we call cartelization policies or non-market policies that basically, shut off competition. So, I mean, you and I know the beauty of a market economy is that when market forces work correctly, prices signal allocation of resources, and demand and supply come together so that there's no shortages or no excesses. And with the most part, the U.S. economy looks not too far from that sort of free market vision for a lot of its history. Obviously, markets don't work perfectly. Sometimes we have shortages, sometimes we have excesses, but there's a ton of evidence that market economies and a lot of, not all markets, but a lot of markets, work pretty well to achieve that vision. In the U.S., it's just glaringly obvious that that's not happening. You've got enormously high unemployment for so long, and you've got these are people that want to work and they can't get jobs. So what's different about the 1930s? Well, wages are incredibly high. So real wages throughout the 1930s are above their normal levels and far above underlying productivity. So imagine, so when I try to explain this to people without a background in economics, I say, imagine you're a worker, you're knocking on the door, and you're saying, hey, I look like that guy in there doing that job. I'm willing to work for half of what he's working. So why don't those, economics is all about, why don't those mutually advantageous trades take place?
And that's a challenge to the Keynesian view, which says wages can't come down. For some reason, they're sticky. You're saying they're not sticky. The guy comes in and says they look sticky, but they really aren't.
There's something impeding that trade, and there's a bunch of evidence that says, no, wages aren't sticky from the perspective of kind of old-time Keynesian theorizing. There's a great paper in the Journal of Economic History by a professor named Curtis Simon at Duke. And, back in the day, the New York Times used to post situation wanted ads. So people would take out an ad in the New York Times and say, I'm a male worker, and this is my experience, and I'm looking for this type of situation. And
instead of help wanted, job wanted.
Job wanted, yeah. Situation wanted. So before the Depression, the asking price of somebody saying, I'm looking for a job, here's what it will take to get me, the asking price and actual wages will basically move within a few percentage points of each other. During the Depression, that was off by a factor of 30%. 30%, never before. So you have to...
So 30% meaning
that
people are willing to work for
30% less than the wages being paid. So again, we say, why aren't those trades taking place? Well, something, almost by definition, is preventing wages from falling. And a lot of my research is focused on the policies of President Hoover and also particularly President Roosevelt in adopting policies that prevented wages from falling. So Hoover had a meeting in, right after the stock market crash on October 29, where he went to Henry Ford was there, Pierre DuPont, Alfred Sloan of GM, U.S. Steel was there, Dow Chemical, and Hoover said, look, your profits have been record highs. I don't want this recession borne on the backs of workers. So you don't cut wages, and in particular, if you can raise them, that would be great. And in return,
so we can keep purchasing power high.
It was this old-fashioned idea of keeping purchasing power high. If the workers have high wages, they'll go out and spend it. There's sort of similar themes to some of the economic advice coming today. And Hoover said, if you do this, I will keep unions off your back. He said, now remember, times have changed. The ways you used to prevent unions from forming, you can't do that stuff anymore. You can't
beat them up.
You can't beat them up or show them a gun and chase them off the property. That world doesn't exist anymore. And GM, U.S. Steel, Bethlehem, DuPont, they kept wages up. Henry Ford actually did a modest wage increase. He hadn't raised wages in a number of years. So now, as you start having some deflation, those fixed nominal wages are starting to become very expensive to employers. So the work I've done suggests that about 60% of the decline of output and work and employment in the Great Depression can be accounted for by this Hoover high wage policy. And what's really interesting is the farm sector, which was about 25% of employment at that time. Manufacturing was about 25% as well. The farm sector wasn't hit by these kind of cartelization policies or wage fixing, anti-competitive policies. Wages fell in the farm sector by a ton. Well, not by a ton, but they fell 20 or 30%. Real output in the farm sector and employment was basically unchanged during the Depression. So you have one major sector of the economy impacted by these non-competitive policies, not allowing the labor market to clear, and you have a huge drop in employment, a huge drop in output. You have another major sector of the economy where the labor market could clear, employment says normal level, output says normal level.
Well, you mentioned Hoover, and that example is what sometimes called job owning. It's not legislation. It's a encouragement with some coercion behind it, or promised coercion. What did Roosevelt do that was along those lines?
He basically doubled down on that policy. So Roosevelt put forward something called the National Industrial Recovery Act,
NIRA.
Which would, the NIRA, which from the standpoint of today's economics would be incomprehensible. It basically said, Roosevelt said to industry, most of the economy, we're going to let you collude and cartelize. So GM, Ford, Chrysler, you guys get together. We want you to set minimum prices, and we don't want you to sell below those prices. It's okay with us if you put quotas on new investment in plant and equipment or quotas on output. We want you to do that. What about the Sherman and Clayton antitrust acts that prevent this kind of activity? We're going to put those aside.
Suspend them.
We're going to suspend those. We'll let you do this as long as you immediately raise wages and engage in collective bargaining. So it was wide-scale monopolization of U.S. industry on the product market side and a huge increase in the relative price of labor. So when we come out of this was put in place in June of 30, I think took place in June of 33. When you look at the recovery, a lot of people will point to, including Christina Romer, who's a terrific economic historian at Berkeley and served on Obama's CEA. People will point to very rapid growth rates in output and say, well, look at that recovery.
Right.
All 80% of that growth was coming from productivity. Jobs weren't coming back. So what Cole and I did was we measured hours worked per adult population during the recovery period. It wasn't all that much different than the recession. It's just that productivity came back in the 30s. And we tie that to FDR's cartel policies. Towards the end of the 30s, to FDR's credit, he gave this great speech where he said, our economy has become like a concealed cartel system like in Europe. What he did at that point was he doubled the size of the DOJ, their antitrust enforcement unit.
Department of
Justice. They started going after cartels, and labor wages started to fall in a relative sense because during World War II, people point to all this government spending during World War II really stimulated the economy. Well, labor policies changed a lot. So FDR met with unions, and he said, I want to make sure there's no strikes. And unions said, as long as we can collectively bargain, there won't be any strikes. He said, great. Well, and I think it was either 42 or 43, Bethel M. Steel agreed to a large increase in wages with the Steelworkers Union. That wage agreement was struck down by the National War Labor Board. The National War Labor Board was put into place to essentially screen and ratify any kind of wage agreements, large-scale wage agreements. And the War Labor Board said, nope, this is inflationary. We're going to limit this wage increase to cost of living. The unions were really upset and went to FDR and said, what are you going to do about this? You said we could collectively bargain. He said, well, yeah, you can collectively bargain, but this is an independent board. This is outside. I can't get involved in this. And wages relative to productivity, which from the standpoint of the work that Cole and I did is kind of the key factor in determining how screwed up these policies are, those wage relative to productivity was almost back to its 1929 level by, say, 1946, 1947. And then you come out of the war, and Taft-Hartley substantially changes the Wagner Act, which in 1935 had given workers and unions enormous bargaining power. So it's a fascinating period. In fact, Cole and I are actually in the process of putting together a book about the U.S. economy from the 1920s through World War II, with a focus on these kinds of policies.
Well, look forward to talking to you about that when it comes out. So how do you understand, let's come full circle. You argue then that in the 30s, there were productive exchanges between workers and employers that could have taken place if there hadn't been some artificial barriers.
Yeah.
Do you see those barriers in place today? Why aren't wage rates falling to clear the U.S. labor market?
So, great question. I think part of it is, there's some workers, there's some compositional effects where a lot of the workers that are not finding jobs are relatively low skilled, and those that are retaining jobs are high skilled. So it looks like compensation rates are not coming down that much, but part of that might be compositional. There's a lot of, at least there's some policies in place now that are changing incentives for job finding. So
let's talk about that, because that brings us to the last thing I want to talk about. We're over time. Do you still have time to continue?
Yeah, I can go for
a little bit longer.
Yeah.
You've written a very provocative, interesting paper on how the housing market has encouraged people to stay unemployed. So talk about that. So possibly, anyway.
Yeah. So I've written a couple of papers about, and they're purely positive papers rather than sort of welfare-based papers.
Meaning the way the world works, not how you would like it or should.
Yeah, exactly. So these are purely papers about how incentives for job finding and job acceptance decisions have changed because of policies. And my most recent work on this relates to foreclosure delay. So today, median time to foreclose on a home is around 15 months. So once you enter the foreclosure process, the average person will get foreclosed on, median person in about 15 months.
Long time.
A long time. In the early 2000s, that was probably closer to 2 or 3 months.
So you get an extra year to live in the house.
Yeah. And the real simple idea is, if you're living in a house and you've stopped making payments and you're reasonably certain that you have a long time to stay in the home and continue not making payments, the incentives to engage in job search, and when a job offer is received, a person's reservation wage, or a wage that they're willing to accept work or decline it, is very different than if you think the sheriff's going to be knocking on the door within the next month and saying, okay, you and your family are out. The incentives are very,
Why?
So on the one case, if you can stay in your home a year or 2 years without making any house payments whatsoever, which is a big chunk of most people's family income, then the marginal value of a dollar is very different than if you have to pony up maybe 50% of your employment benefits to stay in the home. And essentially living free is, so if you're thinking about engaging in job search, you say, okay, here's an offer. Oh, this offer's not that great. Should I take it? Oh, well, I've got this free living situation, so no, I'm not really in that bad of a situation yet. It's very different. You say, I'm in the process of foreclosure. I know the sheriff's going to knock on the door within the next month. I better take this job. It's above unemployment benefits.
Because a month from now, I'm going to have to be making a payment for a rent, or
either I have to get current on my mortgage, or I'm going to be booted out and I've got to make a rental payment. Exactly.
So let's say your mortgage payment. I don't know what the median mortgage payment is in the United States. Not that it's relevant. I really want to know the median mortgage.
It's about $700.
I really want to know what the median mortgage payment is in Nevada or these Michigan or high unemployment states. Yeah. But let's say it's $700. So you're saying I've got an implicit welfare payment I'm receiving of $8,000, $9,000 of a cushion I can fall back on because I'm living rent free.
Yep.
More payment.
That's
free.
Exactly right. Yeah. And this is so this is a paper purely about how it changes the incentives.
But all on the worker side, right?
All on the worker side, all on the worker side, right? It's all about unemployed, essentially unemployed individuals who hold mortgages, And there's about 6 million people in the recent economy who are unemployed and have mortgages. Record high by a large margin.
So it's a little, it's a clever argument. And as a person who believes deeply in the power of incentives, the direction's correct. But so let's look at the skeptical side of this. So I've been unemployed for 2 or 3 years, and I've been hanging on with my house, and all of a sudden I realize I can't make my house payment anymore. And but if I've been talking to my neighbors or been looking in the Wall Street Journal, I know that I got a good year or so before they're going to throw me out. And I think now I don't really have to find a job because I can live rent-free for another year and be unemployed now for 3 years. Aren't there a lot of other factors that are going to dwarf that? My self-respect, what my spouse thinks of me, how I can hold up my head with my neighbors.
Yeah.
You're arguing that for $8,000, I'm going to turn down this good job. I'll get another one in a year. Oh, in a year from now, look. I'm scared about the future. I get a job offer. I'm not going to take it.
Sure.
Besides the argument that it's possibly true, what's the evidence that it actually is true?
Yeah. So we have. So what's pretty striking is that we have evidence from the panel study of income dynamics, the current population survey, that shows unemployment rates and also employment rates among individuals at different stages of delinquency. So 30 days late, 60 days late, 90 days late, and into foreclosure. And what we see is that job acceptance decisions are very different once the foreclosure process starts than, say, 90 days late or 60 days late. Mm-hmm. So it does appear that once people are thinking that the sheriff's going to knock on the door, job finding goes up. So that's some evidence in favor of it.
So a parallel argument then is that the extension of unemployment benefits has been a major factor. So
a lot
overall, of people find that hard to believe.
Again, this is sort of basic incentives. So the evidence we point to is that PSID and CPS data about job finding once foreclosure starts. We're also seeing it somewhat in this. So we have those two sources of data. And the other thing is, we're not saying this is the major reason why unemployment is 8% instead of 4%. We're finding this to be, about at 0.5 percentage point of unemployment, which is significant, but leaves a lot of room for other factors.
It's not the problem.
It's not the problem,
but it's part of the problem.
Yeah.
Okay, we're over time. Let's close by talking about the future. I've got a feeling what you might say, but optimistic, pessimistic, going forward. Doesn't look so good, but you have any cheerful news for me?
This is still the place to be. No matter how bad things look here, Europe is a lot worse.
It's true.
One reason maybe why we were so strong in the 80s and 90s is because we didn't face a lot of competition. We didn't have China developing the way it was. We didn't have, Latin America was a basket case in the 1980s. We are facing more competition now. The U.S. economy has always been, there's no country or economy more resilient than the U.S. So I'm always optimistic about the United States. But my optimism would be stronger if I saw Washington doing some more sensible things. And hope springs eternal. Hopefully Washington will do some more sensible things in the coming years.
No way of knowing. My guest today has been Lee Ohanian. Lee, thanks for being part of EconTalk.
Thanks, Russ. I enjoyed it.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.